Welcome to the deep dive. Today we are plunging headfirst into the complex, often turbulent waters of the global economy. Our guide. Well, it's the very latest thinking from the financial frontline. We're going to take a deep dive into the World Economic Forum's chief economist's outlook, specifically the May 2025 edition.
That's right.
Now, this isn't your average economic forecast. It's built on extensive policy research, consultations, and crucially, it incorporates direct survey data from leading chief economists.
And these are really the top people advising governments, major corporations, public and private sector.
Exactly, the sharp minds. And the survey itself was conducted in the first half of April 2025, which, as the report makes pretty clear, turned out to be a pivotal moment for global policy.
It really did. Timing was key there.
So our mission for this deep dive is to really help you navigate this complex report. We want to cut through some of the maybe academic language and extract the absolute most important insights, the essential nuggets you need to understand the emerging contours of the global economic environment right now.
Absolutely. And the report, it sets a rather somber tone right from the outset. It distinctly frames the current period as one of extraordinary volatility and uncertainty. That's the language it uses.
Extraordinary volatility.
Yeah, and it points to what it calls compounding shocks hitting the global economy kind of all at once. On one side, you've got the increasing intensity of geoeconomic and geopolitical events. Think trade tensions, political shifts. And on the other side, you're seeing this incredibly rapid, truly transformational impact of technology, specifically artificial intelligence, AI.
Right, the two big forces.
Exactly. And according to this specific survey of chief economists, the overall global economic outlook has, well, undeniably darkened quite noticeably just since the beginning of this year.
Okay, that's a powerful starting point. A darkening outlook, driven by geopolitical shocks and tech transformation. So what we really need to unpack today is why. Why do these leading economists feel this way?
Yeah, what's underneath that?
We'll dive into that unanimous expectation. Among them, you mentioned it darkened, but they all expect it to weaken. That's huge. We need to explore the specific, and I think quite surprising, details around recent U.S. policy shifts, the tariff situation, and the expected significant impacts, even, despite the recent pauses we've heard about.
Right. The nuances there are important.
Then we'll zoom out a bit and look at the vastly different regional outlooks this report highlights. I mean, who's really struggling with these headwinds, and who might be seeing maybe small glimmers of potential improvement?
Because it's definitely not uniform across the globe.
Not at all. And we'll dedicate some serious time to understanding this age of uncertainty the report describes in quite some detail. What specific factors are fueling it beyond just the trade stuff? And how is that pervasive uncertainty actually affecting, crucial decisions for businesses, for governments?
A real-world impact. Yeah.
And finally, we absolutely have to take a deep dive into AI, exploring its complex sort of dual nature. It's seen as both a deeply disruptive force, maybe with significant downsides, but also a major source of long-term opportunity.
A double-edged sword, for sure.
This is a lot to get through, so let's just dive straight in. Where do we start with this weakening outlook?
Okay. Well, the report really doesn't pull any punches right away. It explicitly states there is a unanimous view among the chief economists surveyed, and that means 100% consensus, which is rare.
Wow.
Yeah, unanimous view that the condition of the global economy is set to weaken considerably for the rest of 2025. So this isn't just like a slight dip they're talking about. They see a significant deterioration coming down the pike.
Considerably, not just weaken.
Exactly, and it's particularly striking when you compare it to the sentiment captured in their previous survey, which was back in November 2024. At that point, the outlook was, well, significantly less gloomy. The shift in sentiment in just those few months is actually quite dramatic.
Okay, unanimous expectation of weakening. That's really telling. And the report seems to pinpoint one specific major shock that kind of triggered this big shift in expectations.
Yeah.
What was that key event?
Yes. The report identifies a series of historic changes in U.S. trade policy as the principal shock, the main thing that really rocked confidence globally. Specifically, it points to the announcement made back on April 2nd.
All right, early April. What happened?
This involved a pretty dramatic increase in U.S. import tariffs. The plan announced was to establish a 10% baseline tariff on most global goods entering the U.S., so effectively raising tariffs across the board.
Wow, 10% baseline on those things.
Yeah, and then applying much higher rates. That's the phrasing on goods coming from countries that had substantial trade surpluses relative to the United States, so targeting specific countries too.
Okay, so a double hit. potentially.
And this was seen immediately as a major unilateral policy pivot, a big shift with potentially really wide-ranging consequences. The report notes that this initial announcement, right after it happened, it triggered financial market convulsions as investors and markets tried to process the potential fallout. What does this actually mean?
I can imagine. That's a big move to digest. But as often happens with these things, the situation evolved pretty quickly, right? The report mentions some subsequent developments, particularly involving pauses on those tariffs.
Yes, exactly. And this is crucial context for understanding the ongoing volatility, the uncertainty we talked about. After that initial April 2nd announcement, the U.S. did announce a 90-day pause on most of the higher tariffs that had been proposed.
Okay, but some relief?
Some, yes, but the report highlights a notable exception at that time.
Yeah.
The specific tariffs targeted at Chinese imports. They were not included in that initial pause. In fact, they were pushed even higher in some cases, up to 145%.
Wow, 145%.
Yeah, huge numbers. And this naturally led to a reciprocal response from China. They suspended exports of a range of critical minerals to the U.S., tit for tat.
Right, escalation.
But then, about a month later, on May 12th, there was another announcement. This time, kind of a de-escalation, specifically on the U.S.-China front. The report notes the U.S. and China announced a 90-day reduction of 115 percentage points on their bilateral tariffs.
Okay, wait. A reduction of 115 percentage points. That sounds like basically undoing the huge increase.
It's essentially winding back a large chunk of those very recent, very high increases, a significant reversal. And alongside that, China agreed to lift its export restrictions on those critical minerals.
So a major shock in early April, then a partial pause later that month, but not for China initially, leading to retaliation, and then a more significant pause and de-escalation specifically between the U.S. and China in mid-May. It's a lot of back and forth.
It's incredibly volatile. Whiplash, really.
So how did the Economist, when they were surveyed, which was in the first half of April, remember right after that initial shock, but before the May 12th U.S.-China pause, how did they view the impact of all this volatility at that specific moment?
That's the key timing. The report explicitly notes that while the subsequent pausing of tariffs, particularly that U.S.-China announcement on May 12th, did bring significant relief, you saw it in financial markets, a clearly positive market response. The core finding from the April survey period is pretty profound.
Yeah, what was it?
At that time, the chief economist saw that the underlying uncertainty about U.S. economic policy persists. The report uses strong language. It says the sheer volatility of decision-making has triggered questions about the continuing reliability and predictability of economic policy in the U.S.
So even if they paused some things later, the damage to confidence, the questioning of predictability was already doing.
That seems to be the implication from the April survey timing. And there's a truly striking statistic in the report to back this up. Based on data leading up to that April survey period, the level of trade-related uncertainty recorded in those 3 months was higher than at any time since records began in 1960.
It's since 1960, higher than any point in over 6 decades.
Higher than any point. Just think about that. All the crises, the oil shocks, the financial crises. This period leading into April 2025 saw higher trade uncertainty than any of them.
Wow.
It far exceeded the levels seen even during the most uncertain points of the COVID-19 pandemic. It even exceeded the uncertainty levels in April 2025 itself when the survey was happening. So this wasn't just a minor fluctuation. The economists were seeing absolutely unprecedented levels of policy uncertainty stemming primarily from the U.S. trade actions at that moment.
Higher than the COVID peak. That statistic really hits you. I mean, it puts this current moment to a historical perspective that's frankly genuinely alarming. So, okay, what does that extreme level of policy uncertainty actually do? What are the consequences for economies, for the decisions people and businesses make?
That's the critical question, right? And this level of uncertainty, it has tangible, often quite damaging effects on economic activity. The report highlights several key consequences. First, and maybe most obviously, it leads to stalled decision-making.
People just freeze.
Pretty much. Businesses, investors, even consumers become hesitant. When the rules of the game, especially around something as fundamental as trade and investment costs, are unpredictable, you tend to wait and see. You delay hiring decisions. You postpone that big capital investment in a new factory. You put off strategic shifts until there's, more clarity.
Makes sense. You don't want to commit resources if the landscape might completely change tomorrow.
Exactly. Second, the report says it heightens the risk of policy miscoordination. Imagine different countries, or even different parts of a single economy, making policy decisions based on incorrect assumptions about what others are going to do simply because everything is so unpredictable.
So everyone's guessing, and the policies might end up conflicting or just being inefficient.
Precisely.
Yeah.
Leading to conflicting policies, inefficiencies, maybe even amplifying the negative shocks globally. And third, it directly disrupts global value chains. Companies have spent decades building these incredibly complex, optimized cross-border supply networks.
Just in time everything, relying on smooth flows.
Right. And unpredictable tariffs or sudden restrictions force them to fundamentally reconsider their entire operational structure. Where do we source from? Where do we produce? Do we need more inventory? All of this is incredibly costly and time-consuming to change, and it adds significant friction to global trade flows.
Okay, stalled decisions, policy confusion, disrupted supply chains. That sounds like a recipe for slower growth right there.
It certainly points in that direction.
Okay, let's rewind slightly. Back to the direct impact of those initial higher tariffs announced in April, before the pauses came into effect. According to that April survey, what did the chief economists actually expect to happen to prices and trade volumes if those tariffs were fully implemented as announced?
The survey results, which are laid out clearly in Figure 3 of the report, were quite definitive on this point. When they were asked about the likely impacts of higher tariffs, a significant majority, 77% of these chief economists, agreed or strongly agreed that higher tariffs will lead to higher inflation.
Okay, three-quarters expecting higher prices. What's the basic mechanism there? Just import costs.
Well, yeah, the basic economic mechanism is pretty straightforward. Tariffs are essentially a tax on imported goods. So when those taxes go up, the cost of bringing those goods into the country increases. And those higher costs, they're very often passed along the supply chain.
Right, businesses aren't usually just going to eat that cost, especially if it's widespread.
Exactly. Wholesalers pay more, retailers pay more, and ultimately it's typically the consumer who sees higher prices on the shelves. So that's the direct link to inflation.
Okay, that makes sense. What about the impact on trade itself, the amount of stuff moving around the world?
The consensus there was even stronger. A massive 89% of respondents agreed, or strongly agreed, that global trade volumes will stagnate or decline as a result of these tariffs being implemented.
Stagnate or decline. So almost 9 out of 10 economists saw global trade taking a hit.
A very strong consensus. And the report even cites a specific, concrete forecast from the World Trade Organization, the WTO. At the time, the WTO estimated that the threatened tariffs, if fully enacted, would cause global merchandise trade volumes to actually contract by 0.2% this year.
So not just a slowdown, but an actual contraction in global trade volumes, according to that WTO forecast. That's a clear negative impact.
A very clear negative forecast based on those initial tariff announcements. Higher costs for consumers and less global trade overall. That was the expectation captured in April.
Okay, so higher prices, less trade. But who did the economists expect to feel the pain the most? I mean, tariffs are targeted, right? Did they think the damage would be contained? The report also asked them about who would likely be harmed by these U.S. tariffs, looking at Figure 4.
Yeah, Figure 4 provides a more nuanced view than you might initially assume. While obviously the countries directly targeted by the tariffs would be impacted negatively, the economists surveyed saw the damage spreading much wider than that.
How so?
Just over half, 53% of the respondents, expected the damage to fall mainly on the U.S. and the targeted countries. So a shared pain, essentially.
Okay, so a recognition that tariffs often hurt the country imposing them to.
Exactly. Through mechanisms like higher input costs for domestic industries that rely on those imports, or perhaps through the effects of retaliation, or just generally reduced economic activity. But crucially, almost a third, 32%, foresaw the tariffs causing a broader drag on the global economy as a whole.
So not just hurting the U.S. and the target, but actually slowing down the entire world economy.
That was the fear for nearly a third of them. And what's particularly fascinating here, I think, is the near absence of any positive or even neutral outcomes expected. None of the chief economists surveyed expected the tariffs to cause no economic damage at all. 0%.
Nobody thought it would be harmless.
Nobody. And only a tiny fraction, just 3%, expected the damage to be limited only to the targeted countries. So even before you factor in the almost certain retaliation from other nations, the clear consensus among these experts was that these actions, as announced in April, would inflict widespread economic harm.
And speaking of retaliation, it seems the economists saw that as a very likely, almost inevitable outcome, right?
Oh, absolutely. Figure 5 in the report details the expected forms of retaliation, and there's strong consensus that countermeasures were definitely coming. A solid majority, 57% of respondents, expected other countries to primarily respond by raising their own counter tariffs on U.S. goods.
So tariff war, basically.
That was the most expected response, yes. Another 22% anticipated retaliation involving non-tariff barriers.
What are those exactly? Like extra paperwork.
Yeah, it can be things like introducing more complex or stricter regulations, maybe new customs procedures, technical standards, things specifically designed to make imports from the U.S. more difficult or costly, without actually being a direct tax or tariff.
Okay, more subtle, but still damaging to trade.
Exactly. And then 19% expected the use of other economic policy levers, which is a bit of a catch-all, but could include things like investment restrictions, maybe subsidies favoring domestic companies over U.S. competitors, that sort of thing.
And almost no one thought there'd be no retaliation.
Only a tiny minority, a mere 3%, expressed no expectation of any retaliation at all. So, the widespread expectation of countermeasures just adds yet another significant layer of risk and uncertainty onto this already fragile global trade landscape. It becomes a cycle.
Okay, so unpredictable and escalating trade policy, primarily from the U.S. back in April, is clearly identified as a major driver of this volatility and the darkening global outlook. But the report also points to other significant geopolitical and political factors that are compounding the uncertainty, according to Figure 6. What are these broader forces the economists are highlighting beyond just tariffs?
Right. The survey asked about these broader trends, and there was, again, striking consensus among the chief economists. Almost all of them surveyed, a remarkable 95% anticipate that political polarization will lead to suboptimal economic decision-making this year.
95%, that's huge. What do they mean by suboptimal decisions?
Well, the report links this observation directly to recent global electoral trends. It notes that in developed economies that held elections back in 2024, pretty much every governing party lost vote share. And very often, that share went to parties espousing more populist or nationalist platforms.
So the idea is that increased political division makes it harder to agree on sensible, stable economic policies.
That seems to be the connection they're drawing. That polarization hinders effective, maybe more pragmatic economic governance. And hand in hand with this, an equally strong 94% of respondents anticipate that economic nationalism will increasingly drive economic decision-making.
So countries looking inward more, protecting their own industries.
Exactly. We're seeing this play out in practice with the rise of protectionism, things like tariffs, subsidies, prioritizing domestic industries even if they're less efficient globally, and just a general retreat from purely globalist economic principles in favor of national interests.
And there was one more really high percentage there, right? About fragmentation.
Yes, perhaps the most fundamental shift they see. A near universal 98% anticipate that the pace of geoeconomic fragmentation will accelerate.
Geoeconomic fragmentation. Explain that a bit more. It sounds important.
It is. It's a concept that goes beyond just simple tariffs or trade disputes. It describes a deeper, more structural shift where global trade, investment flows, and even supply chains are increasingly being realigned along evolving geopolitical fault lines.
So countries trading more with their political allies, less with rivals, even if it's not purely based on economics.
Precisely. It's about prioritizing political alliances, national security considerations, alongside or sometimes even above traditional economic efficiency or lowest cost. This isn't just about temporary trade spats. It suggests a more lasting change in the fundamental architecture of the global economy.
Wow. That paints a picture of a global economic landscape that is not just uncertain because of specific policies popping up, but structurally shifting based on these deeper political and geopolitical forces. It sounds incredibly complex to navigate.
It is extremely complex.
So what is this turbulent environment marked by these trade shocks, the political polarization, this geoeconomic fragmentation? What does it actually mean for different parts of the world? The report provides a detailed breakdown by region, right? Because it won't hit everyone the same way.
Yes, exactly. And it's really important to note that despite the overall gloomy global picture the survey presents, the outlooks for different regions do vary quite widely. Their individual trajectories are being shaped by, their specific exposures to these global forces, their internal policy responses, their unique domestic challenges, and also their strengths.
Okay, let's start where a lot of this recent turbulence seems to be originating North America, specifically the U.S. Looking at figures 7 and 8 in the report, this feels particularly interesting given the focus on those U.S. policy shifts earlier. What's the outlook there?
Well, the report highlights a really dramatic shift in the U.S. outlook just since the start of the year. As we noted earlier, expectations for the U.S. economy at the beginning of 2025 were actually relatively optimistic based on earlier forecasts like those from the IMF.
Right. Things looked okay back then.
But those April policy announcements we discussed, they noticeably clouded the outlook. When the chief economists were surveyed in that first half of April, remember, after the initial tariff shock, but before that specific May 12th U.S.-China de-escalation, their expectations for the rest of the year had darkened quite significantly.
How significantly?
Almost 4 out of 5 respondents, a combined 79%, that's 69% expecting weak growth, plus 8% expecting very weak growth, anticipated weak or very weak growth for the remainder of 2025.
So nearly 80% expecting weak or very weak growth. That's a major downturn in sentiment.
It is. The report describes it as a significant softening compared to the January edition of the report. Back then, the expectation was much more positive. 47% anticipated moderate growth, and a substantial 44% actually expected strong growth. So going from 44% strong to 8% very weak in just a few months, that's a massive swing.
That really underscores the impact of that April policy shock on confidence. Were there any early data points available by the time of the survey that seemed to confirm this potential slowdown they were sensing?
Yes, the report does mention some early official estimates that seemed consistent with this darkening outlook. Preliminary figures showed that real GDP actually decreased at an annual rate of more 0.3% in the first quarter of 2025.
A contraction in Q1.
Yes. Now, the report does add a crucial nuance here. It says this headline contraction figure actually masked relatively strong domestic demand. It was influenced quite heavily by a rise in imports.
Which might have been businesses stocking up before the expected tariffs hit.
That's the suggestion, yes. So the underlying picture might have been a bit stronger than the headline National 0.3% suggests. But regardless of those nuances, a negative headline GDP number is still significant psychologically and statistically.
Sure. And were there other indicators?
Yes. The report points to more timely, sort of high-frequency indicators that were also trending downwards around the time of the survey in late April. U.S. business activity growth had fallen to a 16-month low. Business expectations for the year ahead had dropped sharply. And consumer sentiment had plunged significantly.
So businesses and consumers were feeling less confident too.
That's what those indicators suggested. The report also observed something it called an unusual combination in financial markets at that time. Rising bond yields happening alongside a weakening dollar. The report suggests this combination pointed to investor nervousness captured during that April survey period.
Interesting. Rising yields, but a weaker dollar. Usually they might move together if growth expectations were strong. So that suggests something else was driving it, like uncertainty.
That seems to be the interpretation offered, yes. Investor nervousness. Of course, it's important to reiterate, as the report notes, the subsequent May 12th U.S.-China tariff pause did lead to a clearly positive market response and a rebound in sentiment after the survey was conducted. But the survey itself captured that snapshot during the period of peak uncertainty in April.
Got it. You mentioned a weakening dollar as a sign of investor nervousness then. How did the economists see the dollar's trajectory playing out specifically for the rest of 2025? Did they expect that weakness to continue?
Yes, the majority did. Just over 3/4, specifically 76%, of the chief economists surveyed back in April expected the dollar to weaken further over the remainder of 2025.
And what are the implications of a weaker dollar, especially in this context?
Well, a weaker dollar has significant implications, particularly for inflation. If the dollar weakens, it makes imported goods more expensive for U.S. consumers and businesses.
Right. You need more dollars to buy the same foreign goods.
Exactly, which would actually add to inflationary pressures domestically. And indeed, the survey shows that inflation remained a major concern for the U.S. outlook at that time. A very high 79% of respondents were anticipating high inflation for the rest of this year.
79% expecting high inflation. That's a huge number. How does that compare to before?
It's a massive jump compared to the previous survey edition back in January. Then, only 15% expected high inflation, so a huge shift in inflation expectations. The report even cites specific closely watched data from the University of Michigan's survey of inflation expectations around that time. It showed year-ahead inflation projected at 7.3%, which the report notes is the highest level recorded since 1981.
Since 1981, that's stagflation-era territory.
It evokes that memory, certainly. And long-term expectations were also elevated at 4.6%. Now, this presents a really complex picture for policymakers, especially the Federal Reserve, because you have these high expectations alongside the fact that the actual headline rate of inflation had dipped to 2.3% in April.
So expectations are high, but the current reading was lower. That's confusing.
Very. And the report points to ongoing uncertainty around the impact of the higher-than-norm pause rates, essentially.
Right.
The interest rates kept on hold that were put in place after the initial April tariff announcement. It was just a very murky picture for inflation.
So you've potentially got a slowing economy, maybe even contracting based on Q1, coupled with stubbornly high expectations of inflation. That sounds like a classic stagflationary dilemma. That certainly makes the Federal Reserve's job incredibly difficult.
It absolutely does. A very tough balancing act. The report implicitly acknowledges this complexity facing the Fed. When asked about monetary policy expectations for the rest of the year, the chief economists were split. Half of them expected a shift towards looser monetary policy from the Fed.
So half expected them to cut rates.
Yes, perhaps anticipating that the slowing growth concerns might eventually outweigh the inflation fears, or maybe thinking that the potential inflationary impact of tariffs might be offset by other disinflationary forces. But the other half presumably expected them to hold steady or even tighten given the inflation picture. So no consensus on the Fed's path forward.
Okay, despite this overall darkening outlook, the policy uncertainty, the inflation worries, were there any specific areas of potential strength or maybe some good news for the U.S. mentioned in the report, perhaps looking slightly longer term?
Yes, there are some more positive signals noted within the U.S. section, which is important in context. The U.S. labor market, for example, is highlighted as having remained relatively resilient through all the turmoil experienced in the early months of the year.
So jobs were holding up okay.
Relatively, yes. While there might have been some indications of softening around the edges, key job data remained pretty steady through March and April, despite the market convulsions and policy shifts. Many chief economists surveyed believe that if the labor market were to weaken significantly, that would be the clear signal of a more disruptive phase for U.S. growth. But as of April, it hadn't broken yet.
Okay, resilient labor market. Anything else?
Looking a bit further out, the report highlights a really striking trend in foreign direct investment, FDI, coming into the U.S., specifically greenfield FDI.
That's investment in totally new projects, right? Building new factories, not just buying existing ones.
Exactly. It's often seen as a measure of stronger, long-term commitment from foreign companies. And U.S. greenfield FDI surged by an incredible 93% to $266 billion.
Wow, nearly doubled. What was driving that?
The report indicates this increase was largely driven by substantial semiconductor megaprojects. Think big chip factories being built, likely spurred by government incentives and strategic goals.
Ah, the Chi-Chi-S Act effect, maybe.
That seems a very likely contributor, yes. So it suggests that despite the overall macroeconomic volatility and uncertainty, the U.S. retained significant targeted strength in attracting certain types of strategic long-term investment, particularly in these high-tech sectors deemed critical. It shows a pocket of real resilience or targeted strength.
That is a substantial increase in greenfield FDI, especially impressive given the overall uncertainty we've been talking about. Now, what about the U.S.'s closest neighbors, Canada and Mexico? They have incredibly integrated economies with the U.S., supply chains running back and forth constantly. How exposed are they to all this volatility and uncertainty coming from the U.S.?
They are acutely exposed, perhaps more than any other region, precisely because of that deep trade and supply chain integration you mentioned. The U.S. economy sneezes, and they often catch a cold, as the saying goes. And the report clearly demonstrates this vulnerability by citing the latest projections from the IMF, the International Monetary Fund. Their April forecasts, remember, these were done when the uncertainty triggered by the initial U.S. policy announcements was really at its peak, showed significant downward revisions for both Canada and Mexico for 2025.
How bad were the revisions?
For Canada, their growth forecast was downgraded by a notable 0.6 percentage points, bringing it down to just 1.4% growth expected for the year. And in Mexico, the potential repercussions looked even more pronounced. The IMF was forecasting that Mexico's real GDP would actually contract by 0.3% this year.
Negative growth for Mexico.
Yes, and that was a sharp downgrade of 1.7 percentage points from their previous forecast, a really significant hit.
And does the report explicitly link these downgrades to the U.S. situation?
It does. The report notes that the sharp downgrade for Mexico, and the one for Canada too, is attributable to a confluence of external shocks, but it singles out one, most notably the imposition of new tariffs by the U.S.
So there it is again, a clear link.
Yes. It provides one of the clearest examples in the report of the direct negative ripple effect that U.S. policy uncertainty can have on economies that are so tightly linked to it through trade and investment. The impact wasn't just hypothetical, it was showing up in major forecast revisions.
That's a really stark illustration of that interconnectedness. Okay, let's shift our focus now across the Atlantic to Europe, looking at figure 9 and 10 in the report. What's the economic picture emerging there, according to these chief economists? Is it as gloomy as the U.S.?
It's different. The outlook for the European economy actually shows some signs of improvement, according to the survey, which is interesting given the global context. However, the report is careful to emphasize that this improvement is starting from a weak base after a period of pretty lackluster growth in Europe.
So getting better, but maybe not great yet.
That's a fair summary. Still, it does represent a more optimistic view compared to previous surveys of these same economists. Looking at the numbers, half of them surveyed still expect growth in Europe to remain weak this year.
50% still weak.
Oh, yeah.
Okay.
Yeah, and that aligns broadly with the IMF's latest projection, which was for 0.8% growth for the Eurozone, so still quite sluggish. Only 11% anticipates strong growth in Europe. But the fact that expectations for weak growth are not overwhelming, that it's only half, represents what the report calls a notable improvement in sentiment compared to before. Things are looking slightly less bad, perhaps.
Okay, so cautious optimism might be too strong, but definitely an improvement in the mood. What are the key factors driving this slightly brighter picture in Europe? What are they seeing?
One of the key factors highlighted is the increasing expectation among these economists for an expansionary shift in fiscal policy across the continent. Governments spending more, basically.
Ah, okay. More government support.
Yes. This is now expected by a significant 77% of the chief economists surveyed. And the report explicitly connects this potential shift back to our earlier discussion about U.S. policy developments and the broader geopolitical environment. It suggests that these external pressures, the U.S. trade actions, the war in Ukraine, the general uncertainty, have actually galvanized the sense among European policymakers that action is needed to bolster their economies, security, and societies. There seems to be a growing consensus, or at least an expectation, that Europe needs to be more proactive in using government spending to support its economies in this challenging environment.
Interesting. So the external shocks are actually pushing Europe towards more internal stimulus. Are there specific examples of this potential shift in fiscal policy mentioned? Like which countries?
Yes, Germany is presented as a leading example, maybe even the main driver of this trend. The report details what it calls a dramatic overhaul of Germany's traditional, very conservative fiscal framework.
You mean the debt brake? They've always been very focused on limiting debt.
Exactly. The report mentions a relaxation of those constitutional debt constraints, the Schuldenbremse. And this move is specifically intended to allow for sharp increases in infrastructure and defense spending.
Ah, defense spending again. We talked about that rising globally.
Yes, it connects back. And looking at figure 10 in the report, half of the surveyed chief economists actually expect that this significant change in Germany's fiscal stance, Germany being the largest economy in Europe, will drive an acceleration of growth across the continent.
So Germany spending more could actually lift other European economies too, a spillover effect.
That's the expectation from half of these experts, yes. A potential positive engine for the region, driven by this German policy shift.
Okay, so fiscal policy is expected to become more supportive, led by Germany. What about monetary policy from the European Central Bank, the ECB? Is that also expected to provide a tailwind for growth?
Yes, monetary policy is also anticipated to lend some support to European growth. 76% of the respondents anticipate continued monetary policy loosening from the ECB. So lower interest rates, or at least not higher ones.
Has the ECB already been cutting rates?
It has. The report notes that the ECB had already cut its key policy rate down to 2.25% back in April. And it highlights that this was actually the seventh cut the ECB has made since June 2024.
Seventh cut already. Wow, they've been quite aggressive in easing then.
It indicates a sustained trend towards easing monetary conditions over the past year or so, trying to give the European economy more room to breathe and grow.
And is inflation a major constraint for the ECB's ability to continue easing? Is it as big a worry as it seemed to be in the U.S. according to the survey?
Not as much, apparently, at least not according to the chief economists surveyed. The report notes a favorable inflation environment in Europe compared to some other regions, like the US. And this environment is expected to give the ECB room to continue lowering rates if they choose to.
What are the actual inflation expectations for Europe?
According to the survey, inflation is expected to remain moderate by a majority, that's 54% of respondents, or even low, 31% this year. So much less concern about high inflation compared to the US figure of 79% expecting high inflation. This suggests inflationary pressures are seen as relatively contained in Europe for now.
Okay, that's a key difference. Europe's seeing improving sentiment, potential fiscal boost led by Germany, and an ECB that has room to keep easing because inflation isn't seen as a major threat right now. Let's turn our attention now to East Asia and the Pacific, and let's start with the giant there, China. Looking at figure 11 and 12, China set a 5% GDP growth target for 2025, same as last year. How did the chief economists view its prospects of actually reaching that goal this time around?
Well, China's target of 5% GDP growth for 2025 is, as you said, unchanged from its 2024 target. But the report suggests it's likely to be more difficult to achieve this year. And the main reason cited is, again, the roiling of the global trade landscape that we discussed extensively earlier.
So the trade headwinds are hitting China's target expectations too.
That seems to be a major factor, yes. Among the chief economists surveyed, the majority view for China's growth this year is moderate. 69% expect that outcome for the rest of the year, but another 20% anticipate that growth will remain weak, so not a huge amount of optimism there.
And specifically on hitting that 5% target itself, is there a clear consensus among the economists? Do they think China will make it?
No, Figure 12 explicitly shows there is no clear consensus among them on whether China will ultimately reach its 5% target this year. The opinions are really quite divided.
Divided.
You've got 16% who strongly disagree that China will reach the target, another 30% who disagree, so almost half are disagreeing to some extent. Then you have a substantial chunk, 32%, who are uncertain, they just don't know. Only 19% agree that China will hit the target, and a mere 3% strongly agree.
Well, only about 22% agreeing versus nearly half disagreeing, and a third are unsure. That division really highlights the challenges Beijing faces in achieving that goal, doesn't it?
It really does. It suggests considerable skepticism among these global experts. The report also mentions that the IMF recently revised its forecast for China down to 4% growth for the year, although it adds an important caveat. This revision was done before that May de-escalation of U.S.-China trade tensions we talked about.
Right, so maybe things look slightly better now than when the IMF made that 4% call.
Possibly. But it remains to be seen how much positive impact that de-escalation actually brings in practice, especially since, as the report notes, substantial U.S. tariffs around 30% on many Chinese goods and the retaliatory Chinese tariffs around 10% on many U.S. goods, they remain in place. Despite that temporary 115 percentage point reduction on some bilateral trade, the underlying tensions haven't vanished.
Good point. So given these challenges, what about potential policy support from Beijing to help meet this target? Are policymakers expected to step in with stimulus?
Yes, policy support is widely anticipated by the chief economists. The vast majority of respondents expect looser fiscal policy, that's 87%, and looser monetary policy, 73%, in China this year. They expect Beijing to pull levers to support growth.
Okay, why looser monetary policy? Is inflation low there?
Yes, that's a key difference with the U.S. and even Europe. On the monetary side, China's policymakers are contending with what the report calls long-standing deflationary risks. Prices aren't rising much or are even falling in some sectors. This risk is reflected in the fact that 69% of the surveyed economists expect low or even very low inflation in China this year.
So the opposite problem of the U.S. deflation risk gives them room to cut rates.
Exactly. That environment gives the People's Bank of China more room to ease monetary policy without worrying too much about triggering inflation. On the fiscal side, the report mentions the latest government package aims to support domestic demand by raising the central government deficit target to 4% of GDP and also increasing the spending capacity of local governments, which have faced some financial constraints recently.
Okay, so stimulus is expected, but are there significant domestic challenges weighing on China's outlook as well, even with this expected policy support? Things beyond the trade issues.
Yes, several significant domestic headwinds are highlighted in the report that complicate the picture. Consumer confidence, for instance, back in March 2025, remained well below levels seen in the U.S. and the Eurozone. This indicates a persistent reluctance by Chinese households to spend freely, which weighs on domestic demand.
And the property sector, that's been a big story.
Absolutely. The real estate sector continues to be a major drag on the Chinese economy. Efforts by the government to address excess leverage in the sector and stabilize housing markets have resulted in subdued investment in property development. And there's ongoing financial stress among some key property developers, which has ripple effects.
So weak consumer confidence, property sector woes, those are big domestic drags.
They are. However, the report also notes a significant potential counterbalance, a real strength for China. It possesses a dynamic innovation ecosystem. There's strong growth happening in areas like AI and other frontier technologies, which could provide a lift to productivity and generate new sources of economic activity, potentially offsetting some of the other weaknesses.
Okay, a complex picture for China. Let's look at the wider East Asia and Pacific region now, beyond just China. Referring to Figure 13, how are these other economies faring in this environment?
Economies in the wider East Asia and Pacific region are generally navigating what the report calls a complex external environment. They're dealing with the slowing global trade volumes we've discussed, ongoing adjustments to global supply chains as businesses implement de-risking strategies, and various regional geopolitical tensions that add uncertainty.
So what does that mean for their growth prospects?
Most chief economists surveyed expect growth in this wider region to be moderate, that's 61%, or weak, 30%, for the rest of 2025. So generally subdued, similar to the global picture. Inflation, however, is expected to remain moderate by almost two-thirds, 66% of respondents, suggesting price pressures are less acute than in some other parts of the world.
Any specific countries mentioned in this region?
The report specifically mentions Japan. The Bank of Japan has started a gradual normalization of its monetary policy, moving away from years of negative interest rates. This shift is being closely watched globally, as Japan tries to balance managing nascent inflation with supporting its somewhat fragile economic activity.
How's Japan's growth looking?
Growth in Japan remains pretty muted. The IMF forecasts just 0.6% growth in 2025, although that is an acceleration from a very low 0.1% in 2024. But there are some positive signs noted in the report, like recent Purchasing Managers Index, PMI data showing some improvement, and apparently a surge in new export orders, particularly in the manufacturing sector.
Any other factors mentioned for the region?
The recently concluded trade deal between India and the UK is also mentioned as potentially relevant for the wider region, given India's increasing economic weight and trade links. However, there's also the shadow cast by the potential rerouting of Chinese exports due to the ongoing trade tensions. If Chinese goods can't go to the U.S. easily, they might end up competing more intensely in other Asian markets, which could complicate the picture for China's neighbors, leading to increased competition or maybe even supply chain disruptions for them.
Right, the ripple effects again. Okay, let's move across the globe to Latin America and the Caribbean. Looking at Figure 14, what does the report say about their economic prospects for the rest of the year?
The outlook for Latin America and the Caribbean is generally for weaker growth this year, unfortunately. A majority of the chief economists surveyed, 55% of them, expect weak growth for the remainder of 2025.
Why the pessimism there? What are the main challenges?
The region is facing a difficult combination of external challenges. The report highlights tighter global financial conditions, which means borrowing is more expensive for governments and businesses in the region. They're also facing slowing demand from key trading partners as global trade contracts or stagnates. And, like everywhere else, persistent geopolitical tensions are adding to the overall uncertainty.
And how are these factors impacting the region?
All of these external headwinds are weighing on investment and consumer confidence within Latin America. The report notes that consumer sentiment fell sharply across the region back in March 2025.
Did the U.S. tariff changes we discussed earlier specifically impact the forecast for this region as well? We saw it hit Mexico hard.
Yes, the report makes another direct connection here, providing a clear example of the impact of U.S. policy beyond just its immediate neighbors. It explicitly states that the IMF projects a slowdown in overall regional growth for Latin America and the Caribbean from 2.4% in 2024 down to 2.0% in 2025.
Okay, it's slowdown.
And the report notes this 0.5 percentage point downward revision in the forecast is attributable to a confluence of external shocks, most notably the imposition of new tariffs by the U.S. So again, this region is another place where the expected negative impact of U.S. trade policy is clearly identified as a significant factor weighing on growth prospects.
It really highlights how interconnected things are, even across continents. Is there any single country in Latin America that stands out as having a potentially different, maybe more positive trajectory amidst this regional slowdown?
Argentina is highlighted specifically as a country showing some distinct signs of progress, which is interesting given its recent history of extreme volatility. The report notes signs that its recent series of quite aggressive fiscal and structural reforms are starting to stabilize the economy.
Really? What are the forecasts like for Argentina?
The IMF, for example, expects Argentina to grow by a relatively strong 5.5% this year, and maybe even more significantly, it forecasts a substantial slowdown in Argentina's incredibly high inflation rate, bringing it down from triple digits to around 35.9% in 2025, and then further down to 14.5% in 2026.
Wow, 5.5% growth and rapidly falling inflation. That would be a remarkable turnaround.
It would. These figures certainly offer a potential contrast to the broader regional trend of slowing growth and more persistent inflation challenges. It suggests reform efforts there might be starting to bear fruit, though obviously from a very low base and with risks remaining.
What about the policy options for governments elsewhere in Latin America? Are they expected to use fiscal or monetary policy much to support their economies, given the headwinds?
Generally, policy space, particularly fiscal space, the ability to spend more or cut taxes remains pretty constrained in many economies in the region. This limits the ability of policymakers to use government spending to cushion these external shocks or significantly boost growth. Reflecting this, over two-thirds of the chief economists surveyed, 68%, expect fiscal policy across the region to remain broadly unchanged this year. They just don't have much room to maneuver.
And inflation and monetary policy.
Inflationary pressures are easing in much of the region compared to the recent peaks, but they definitely remain a concern in a number of countries, particularly those with underlying structural imbalances. Across the region as a whole, 38% of the surveyed economists still expect inflation to remain high, while another 55% anticipate moderate levels, so still a significant inflation concern. As for monetary policy, the chief economists are divided. Expectations are split between policy rates remaining either unchanged, 50%, or potentially becoming looser, 39%. Likely depending on the specific country's inflation and growth dynamics. No clear regional trend expected there.
Okay, let's move on to Africa and the Middle East now. Referring to figures 15 and 16 in the report. What does the report say about the economic outlook in these vast and diverse regions? Let's start with the Middle East and North Africa, MENA.
Okay, for the Middle East and North Africa, shown in Figure 15, the chief economists surveyed remains somewhat divided on the growth outlook for the rest of 2025. It's a mixed bag. About half expect moderate growth, but then you have 22% anticipating relatively strong growth, contrasted with 28% who expect weak growth. So quite divergent views there.
What are the key factors influencing that divided outlook in the Middle East region?
Recent developments in global commodity markets, particularly oil, have definitely added to the region's challenges. The report notes that back in April 2025, oil prices actually fell below $60 per barrel and remained near three-year lows at that time.
Below $60. That's quite low compared to recent years. How does that impact the region?
It puts additional pressure on the public finances of the oil exporting economies, which are still heavily reliant on energy revenues to fund their budgets. So many countries in the region continue to navigate that dual challenge, dealing with fluctuating energy prices, while also pursuing the ongoing crucial need to diversify their economies away from that oil dependence in the long run.
And inflation and fiscal policy in MENA.
Across the region, the report says inflationary pressures are gradually easing, but still remain above pre-COVID-19 pandemic levels. Most chief economists surveyed expect inflation to remain moderate, that's 59%. Fiscal space is generally limited, similar to what we saw in Latin America, and most chief economists, 74%, expect fiscal policy to remain broadly unchanged this year. Not much room for stimulus there either.
Okay, now turning to Sub-Saharan Africa, Figure 16. What's the outlook there? Is it similar?
In sub-Saharan Africa, the growth outlook for 2025 is actually described as cautiously optimistic, maybe more so than some other regions we've discussed. A majority of the chief economists surveyed, 61%, expect either moderate or strong growth for the rest of the year.
Moderate or strong? That's more positive. Do external forecasts back that up?
Yes, the IMF projects the region as a whole to expand at a solid pace of 3.8% in 2025 and even accelerate slightly to 4.2% in 2026. So relatively robust growth expected.
But it's a huge and diverse continent.
Yeah.
Are there specific challenges highlighted for particular countries?
Yes. Nigeria, which is one of the region's largest economies, is highlighted as facing distinct and significant challenges. The report mentions that its economy is constrained by persistent structural bottlenecks. Things like major infrastructure deficits, ongoing security concerns in parts of the country, and significant difficulties in the energy sector.
Energy sector difficulties. Didn't Nigeria used to be a major oil exporter?
It still is, but the report mentions a really striking statistic related to domestic energy access. Nigeria currently has the largest number of people without access to electricity in the world.
Wow. Largest number in the world.
Yes. It underscores both the substantial infrastructure investment needs within the country, but also, conversely, the immense potential that could be unlocked for growth and development if progress can be made in areas like power generation and distribution.
That's a powerful statistic. What about inflation and policy across sub-Saharan Africa more broadly?
Inflation is gradually receding from the recent highs seen across the continent, but the chief economists still expect it to remain at moderate to high levels this year. 89% combined expect moderate or high. Food insecurity, often exacerbated by climate shocks and conflict, and external vulnerabilities, particularly high debt levels in some countries, remain significant concerns for many nations in the region. And similar to other emerging regions, significant majorities of respondents expect both fiscal and monetary policy to remain largely unchanged, 78% and 63% respectively, again suggesting limited policy space to respond to shocks.
Okay, finally, let's look at South and Central Asia, referring to figures 17 and 18. What's the economic view there?
South Asia, shown in Figure 17, actually stands out in this report with a relatively robust growth outlook, despite the challenging global environment we've been mapping out. Among all the regions surveyed, the chief economists are most optimistic about South Asia's economic prospects.
Most optimistic. How optimistic?
One-third of them, 33%, expect strong or even very strong growth for the remainder of 2025. That's significantly higher than in most other regions.
That's quite positive. Are there any immediate clouds on the horizon noted?
Yes, the report does inject a note of caution. It mentions that the region's immediate challenges intensified in early May with the outbreak of military exchanges between India and Pakistan. This adds a layer of geopolitical uncertainty that could potentially impact economic stability and confidence in the region.
Right, a reminder of the geopolitical risks there. What about inflation in South Asia?
Across the region more broadly, chief economists expect inflation to be moderate. That's 61% to high 26%. So still a concern, but perhaps not as uniform as in some other areas.
And which country is driving that strong growth outlook for the region? Is it primarily India?
Yes, India is clearly highlighted as the primary engine of growth in South Asia. The IMF forecasts India's GDP expansion at a very strong 6.2% for 2025 and a slightly faster 6.3% in 2026. That's world-leading growth among major economies.
Are there any specific factors mentioned supporting India's growth, despite the global headwinds?
Well, the report notes that although the potential rerouting of Chinese exports due to global trade tensions is casting a shadow over the region's prospects, potentially increasing competition for India too, there are also specific positive signs noted for India. Recent Purchasing Managers Index, PMI data, for example, has surpassed expectations and apparently showed unprecedented growth of new export orders, indicating strong external demand for Indian goods and services right now.
So exports are looking strong.
Seemingly so, based on that data point. And the recently concluded trade deal between India and the UK is also mentioned again here as another potential source of optimism and trade expansion for the country and the wider region.
Okay, that covers South Asia, led by India's strong performance. What about Central Asia? Figure 18.
In Central Asia, the outlook is more moderate, but still fairly stable, according to the survey. Large majorities of the chief economists expect moderate growth, 71%, and moderate inflation, 83%, in the remainder of 2025.
What are the main risks for Central Asia?
The region remains significantly exposed to external shocks, particularly those stemming from shifts in global energy markets, given the reliance of some countries on energy exports. Also, shifts in trade dynamics, especially involving Russia and China, and broader geopolitical developments given its location sandwiched between major powers.
And policy expectations there. Fiscal, monetary.
Fiscal and monetary policy are expected to remain unchanged by about two-thirds of the respondents, with the remainder expecting some degree of loosening. Similar story of somewhat constrained policy space. However, the report does note positive IMF growth projections for many individual countries in the region. It provides specific examples like Kazakhstan, the largest economy, projected to grow at a healthy 4.9% in 2025. Meanwhile, Uzbekistan, Tajikistan, and the Kyrgyz Republic look poised to approach or even surpass 6% growth this year.
So pockets of really strong growth expected in Central Asia, even with the external risks.
Yes, suggesting some resilience or specific growth drivers at play in those countries.
Okay, so we've toured the world. essentially. And we've seen how these major global forces we discussed at the start, the trade volatility, the political polarization, the geoeconomic fragmentation, are playing out really differently across the globe. Some regions, like parts of Europe and maybe South Asia, are seeing potential glimmers of improvement or continued resilience, although often starting from a weak base. Others, particularly those deeply integrated with or exposed to shifts in U.S. policy, like Mexico and Canada, seem to be facing significant headwinds. And all of this brings us back to that broader, pervasive theme that's emphasized throughout the report: uncertainty, just sheer elevated uncertainty.
That's absolutely right. The report makes it abundantly clear that uncertainty isn't just, a background factor anymore. It has become a defining feature of the current global economic landscape. It's not being treated as a temporary blip. It's seen as an active force that's compounding the challenges, actively paralyzing decision-making for businesses and governments, and seriously heightening risks on policy coordination between countries.
Paralyzing decision-making, that's strong language.
It is, and the report points to compelling evidence for this. Multiple global uncertainty indices. These are attempts by economists to actually quantify this sense of unpredictability based on news analysis, market volatility, forecast disagreements, etc. These indices have surged into what the report calls uncharted territory.
Uncharted territory, higher than ever before.
Yes, surpassing even the peaks observed during moments of acute crisis, like the most intense phases of the COVID-19 pandemic or the global financial crisis. We're in historically high levels of measured economic uncertainty.
That's sobering. And how did the chief economists surveyed see this uncertainty playing out in the near future? Looking at figures 19 and 20 in the report, how do they expect current levels of uncertainty to evolve over the next year or so? Do they think it will calm down?
Well, figure 19 shows just how pervasive that sense of uncertainty was at the time of the survey in April. When they were asked about the current levels, a vast majority, 82%, selected very high. Not just high, but very high.
Okay, so almost everyone agreed it was very high then. What about looking ahead, figure 20?
Looking ahead a year from the survey, figure 20 reveals a somewhat mixed picture. There is a small majority, 56%, who expect uncertainty to ease somewhat over the next year. So that offers some degree of hope that things might become slightly more predictable.
Okay, a slight majority expecting improvement. That's something.
It is. However, a very significant portion, nearly half of the respondents, the other 44%, anticipate that uncertainty will either remain at today's extraordinary levels or potentially even exceed them a year from now.
So almost half think this extreme uncertainty isn't going away anytime soon and might even get worse.
That's what it suggests. For a large segment of these leading economists, this period of extreme uncertainty is not being viewed as a short-lived phenomenon that will quickly fade. It's seen as potentially a more persistent state of affairs, the new normal for a while, perhaps.
That's a really worrying prospect, that this extreme uncertainty might stick around. What are the main sources driving this uncertainty, according to the economists? Figure 21 lists several policy areas they were asked about. What came out on top?
When they were asked to select the top 3 policy areas currently displaying the highest levels of uncertainty, the results were perhaps unsurprising given our earlier discussion about the U.S. situation, but still striking in their level of consensus. There was near unanimity, 97% among the chief economists in choosing trade policy as a primary driver.
97% point to trade policy. Okay, that's overwhelming.
Absolutely. As we've detailed, the volatility and sheer unpredictability in this area, particularly highlighted by the April events, are clearly seen as absolutely central to the current uncertain climate.
What came next after trade policy?
It was followed, though, with notably less consensus by monetary policy, selected by 49% of respondents as a top source of uncertainty, and fiscal policy was third, selected by 35%.
So uncertainty about what central banks will do with interest rates and what governments will do with spending and taxes are also major factors.
Yes. It indicates that the uncertainty isn't confined purely to trade itself. The potential reactions and shifts in approach by central banks and governments to these trade shocks, or to the inflation picture, or to other global shifts, are also seen as significant contributors to the overall unpredictability. People aren't sure how policymakers will respond.
And were other areas mentioned too?
Yes. The report also lists other policy areas where uncertainty is considered high by a smaller number of economists, including industrial policy, Think subsidies, national champions, technology regulation, especially around AI, environmental policy, energy policy, and even migration policy. It really illustrates the broad nature of the policy challenges contributing to this climate of pervasive uncertainty.
So it's a multifaceted uncertainty, but trade policy is clearly the biggest piece of that puzzle right now. Now, beyond the direct economic impacts on trade volumes and GDP growth that we've talked about, the report also points to another significant fallout from this heightened geopolitical tension and uncertainty, a notable increase in military spending around the world.
Yes, this is highlighted as a very concrete consequence of these intensifying geopolitical and geoeconomic tensions and the perceived shifts in the global security architecture. The feeling that the world is becoming a more dangerous or unpredictable place. The report notes that this environment is contributing directly to what it describes as the steepest year-on-year rise in global military spending since at least the end of the Cold War.
Steepest rise since the Cold War ended. That's a major claim.
It is, and it's not just a theoretical point. The report cites specific, tangible examples to back it up. For instance, it says all of the world's top 15 spenders on defense increased their military expenditure in 2024, every single one.
All top 15 increased spending. Wow.
And for the first time ever, the United States announced a defense budget proposal that surpasses $1 trillion. Just a massive number. Furthermore, the report connects this back explicitly to our earlier discussion on Europe. Remember Germany's dramatic fiscal overhaul relaxing its debt constraints?
You said it was largely for infrastructure and defense.
Exactly. The report emphasizes that the German shift was largely undertaken specifically to facilitate a sharp increase in defense spending. So this rise in military expenditure is presented as a direct economic cost and a tangible impact of the geopolitical shifts and the heightened sense of insecurity described throughout the report. Money is shifting towards defense.
And how are countries expected to pay for this significant increase in defense budgets, especially when many, as we've heard, are already facing fiscal constraints and high debt levels? Figure 22 gives some insights from the economists' expectations on financing.
Yes, Figure 22 shows how the chief economists expect this increased military spending is most likely to be financed. And the overwhelming expectation, maybe unsurprisingly, is through increased public borrowing. That was selected as likely or highly likely by 86% of respondents.
So governments taking on more debt is the main way.
That's the strong expectation, yes. Looking at other potential sources or trade-offs, more than half, 56%, expect that other spending on public investment, things like building roads, schools, investing in green energy, will actually decline to help offset these rising defense costs.
So less investment in other areas.
That's the fear for over half of them. Similarly, nearly half, 47%, expect that spending on public services like healthcare, social safety nets will also decline. What's perhaps most notable and potentially worrying from a fiscal sustainability perspective is that increased taxes were seen as the least likely means of financing this defense buildup. Only 25% of respondents thought higher taxes were likely.
So borrow more, cut investment, cut services, but don't raise taxes much. That sounds like a path to even higher debt.
That is the clear consequence implied by this expected approach. It points toward a significant increase in national debt levels globally, driven partly by this rise in military spending priorities.
And the report mentions that debt sustainability is already a growing concern globally, even before factoring this in fully.
It absolutely is. Global debt levels have been on a steady upward trajectory for years now, fueled by responses to the financial crisis, then the pandemic. And in an environment where interest rates have risen significantly from their recent lows, even if central banks are starting to pause or cut in some places, the cost of servicing all that existing debt is soaring.
Right. Higher interest payments eat up more of the budget.
Exactly. Higher interest payments squeeze public budgets, potentially leaving less room for that crucial spending on public services or productive investment we just mentioned might get cut anyway. The scale is huge, too. The report cites S&P Global, expecting sovereigns' long-term borrowing to reach a staggering $12.3 trillion globally just in 2025 alone.
$12.3 trillion in new borrowing.
Just in 1 year. And Figure 23 shows a clear and growing concern about debt sustainability among these chief economists. Almost three-quarters, 74%, agreed or strongly agree that debt sustainability will be a growing concern in both advanced and developing economies this year.
Both advanced and developing. That's interesting. Wasn't the concern previously more focused on developing countries?
Yes, the report highlights that as a significant shift. Back in August 2024, in a previous survey, advanced economies were generally seen as less exposed to sovereign debt threats compared to emerging and developing economies. But now, the level of concern is essentially at parity. It underscores the widespread nature of this debt challenge across the globe. It's not just a developing world problem anymore.
Okay, so the overall picture is one of very high uncertainty driven by trade and geopolitics, leading to increased military spending, which is likely financed primarily by more borrowing, and that just exacerbates already high and widespread concerns about debt sustainability. It's quite a tangle.
It's a very challenging constellation of factors.
So, given all this, what are the most likely adverse impacts of this heightened economic uncertainty overall? We know it slows decisions, but what are the biggest expected hits to the economy? Figure 24 lists what the economists see as most negatively affected.
Yes, Figure 24 shows the top 3 areas that these chief economists expect to be most adversely affected by this high level of global economic policy uncertainty. Unsurprisingly, given its central role as both a driver and victim of this uncertainty, trade volume comes out right on top. It was selected by 70% of respondents as likely to be negatively impacted.
Makes sense. Uncertainty kills trade deals and flows.
Exactly. Closely behind trade volume is overall GDP growth, selected by 68%. As we discussed earlier, uncertainty directly dampens growth because it causes those delays in crucial economic decisions. Businesses hold off on hiring, they delay capital investment projects, consumers might postpone major purchases. It all adds up to slower economic activity.
Okay, trade and growth. What's the third one?
Foreign direct investment, or FDI, is also high on the list, selected by 62%. Uncertainty creates risk, and those big long-term investment decisions like building a new factory overseas or acquiring a foreign company are particularly sensitive to that perceived risk. If you don't know the rules or the stability of a market, you're less likely to make a huge long-term bet there.
And is there evidence FDI is already being hit?
Yes, the report notes that global FDI already declined by 8% back in 2024. And while there were projections for some improvement in 2025 made before these latest tariff announcements and a surge in uncertainty, the report suggests that improvement now seems unlikely given the current geopolitical and geoeconomic outlook. So this shows a concrete negative impact on global investment flows already happening and expected to continue.
Trade, GDP growth, FDI. Those are the big 3 casualties of uncertainty. Are others mentioned?
Yes, other expected adverse impacts mentioned, though by fewer respondents, include domestic capital investment selected by 35%. Inflation, 27% uncertainty can sometimes be inflationary too, disrupting supply. And financial markets, 24% reflecting volatility. But trade, growth, and FDI are seen as the primary victims.
Okay. Given this incredibly challenging environment then, with sky-high uncertainty and significant headwinds hitting trade, growth, and investment, how are businesses actually expected to react? What adjustments are multinational companies likely to make over the next 3 years to cope with this? Figure 25 gives us some clues.
Yes, Figure 25 provides a really clear picture of how firms are anticipated to adapt to this new, uncertain reality. The most widely anticipated response, expected by a unanimous 100% of the chief economists surveyed, is that businesses will reorganize sourcing and logistics to reduce exposure to tariffs or export controls.
100% expects supply chain reorganization. Everyone.
Every single respondent expected this. It speaks volumes about how central this issue has become. This is all about building resilience into supply chains. It means diversifying networks, reducing dependency on single countries or suppliers that might suddenly become vulnerable to policy shocks, the strategy people are calling de-risking, or sometimes friendshoring.
And are companies actually doing this already?
The report notes there is already considerable anecdotal evidence and some emerging data showing firms actively reorganizing their supply chains in response to these pressures. It's not just talk, it's happening.
Okay, reorganizing supply chains is number 1. What's another major adjustment expected?
Another major expected adjustment, cited by a large majority of 87%, is for companies to delay strategic decisions and investments.
There's that stalled decision-making again.
Exactly. And this is highlighted as a significant and somewhat worrying finding because it represents a change from the previous survey. Back then, this kind of wait-and-see strategy, delaying big decisions, was largely ruled out by the economists. But now, the level of uncertainty is seen as so high that it is causing firms to pause major commitments. Things like expanding into new markets, investing in major new technologies, or building new production facilities.
And why is that worrying? Just because it slows things down?
Yes, the report explicitly warns that this widespread delayed decision-making actually heightens the risk of a global recession, because postponed investment directly slows down current economic activity and future growth potential. It's a significant drag.
Okay. Reorganizing supply chains, delaying big decisions. What else? Are they moving production?
Yes, that's another key strategy expected by a large majority, 84% of respondents. For businesses to snip production and investment to regions less affected by tariffs or controls.
So physically relocating factories or investments to safer havens.
Exactly. It involves moving manufacturing facilities or capital investments to locations perceived as more politically stable or less likely to be hit by restrictive trade policies, or perhaps places offering new incentives. The aim is often to circumvent tariffs or controls imposed elsewhere and maintain a competitive advantage.
Is there much evidence of this happening yet? Where are they moving?
Well, the report notes that uncertainty about which alliances might form or how long policies will last definitely weighs on these relocation decisions. It's risky too. But it does mention some examples, like the chip company NVIDIA apparently relocating some production back to the U.S., likely driven by factors like the HPS Act subsidies and other domestic policy priorities favoring onshore production in strategic sectors. So movements are happening, but maybe not always in the initially expected directions.
Interesting. Are there other strategies businesses are expected to pursue?
Yes, several others are seen as likely. Increasing policy monitoring and political engagement in key markets is expected by 76%, essentially. Companies needing to invest more in just understanding the shifting political and regulatory landscape to try and stay ahead of changes. Aligning operations with new geopolitically driven opportunities is expected by 84%. Actively looking for ways to benefit from new government policies like subsidies or protected markets that might emerge in this fragmented world.
So playing the geopolitical game in a way.
You could put it like that. On the more defensive side, 84% also expect businesses to simply reduce exposure to markets deemed geopolitically high risk, just pulling back from unstable places. Finally, many also expect firms to focus internally on increasing their organizational capacity and agility, 62%, so they can respond more quickly to unexpected changes, and enhancing their strategic and organizational diversification, also 62%, across different markets and business activities to spread their risks.
That's a lot of adaptation required. Reorganize, delay, shift, monitor, align, reduce risk, become more agile.
It is. The report concludes this section by really emphasizing the complexity of the situation for businesses. They're being forced to balance this need for proactive adaptation to the new geopolitical reality with the significant risk of overextending their resources or making the wrong bets or delaying crucial investments for too long in this highly uncertain environment. It's a tightrope walk.
Okay, so that covers the first major force shaping the global economy in this report. This profound volatility and uncertainty driven by geopolitical shifts, particularly those unpredictable trade policies, leading to fragmentation and major business adjustments. Let's turn now to the second big force the report focuses on, the rapid advancements and the growing impact of artificial intelligence, AI. How does the report frame the role of AI in this current economic landscape, which, as we've just heard, is already so challenging?
The report describes AI as adding essentially another layer of complexity and opportunity onto this already disrupted global economic landscape. It's seen as a powerful force in its own right, acting as a source of both short-term volatility as industries start to really grapple with its implications and potential disruptions, and also as a driver of much longer-term structural shifts that will fundamentally alter how economies function, how we work, how value is created.
And it emphasizes the speed, right?
Yeah. Yes, the report really stresses the extraordinary speed at which this AI revolution seems to be unfolding, especially compared to previous major technological shifts like the internet or electrification. Things are moving very, very fast.
So given that speed, what's the economist's view on the current level of AI disruption? Is it already widespread and shaking things up commercially right now, or is the big impact still a bit further out for most sectors? Figure 26 touches on this.
Yeah, Figure 26 provides some interesting insight into the current perceived reality versus maybe the future hype. When asked specifically about AI being commercially disruptive in 2025, only 45% of the chief economists surveyed actually expected that to be the case this year.
Only 45%. Less than half think it's disruptive this year.
Yes. And there was also significant uncertainty around this point, with another 42% saying they were simply uncertain about the extent of commercial disruption in 2025. So while you hear these massive projections for the future market size of AI, the report cites some estimates as high as $4.8 trillion by 2033. And while the costs for accessing powerful AI systems are falling rapidly,
The actual widespread adoption isn't quite there yet.
that seems to be the view captured here. The report notes that widespread adoption across industries has yet to take place. It might be happening fast in some pockets, like tech itself, but the truly transformative, broad-based commercial disruption across the entire economy might still be a bit further out for many sectors compared to some of the more breathless headlines.
Okay, so the widespread disruption isn't fully here yet, maybe. But what about the long-term impact on global GDP growth? This is where some of the really optimistic projections about AI tend to focus. Does AI offer a way out of the sluggish growth we've seen recently?
That's the big hope, isn't it? And external projections for the cumulative boost to global GDP from AI, say, over the next decade or so. By 2034, they do vary incredibly widely. The report mentions ranges from a relatively modest 1% cumulative boost all the way up to over 20% in some of the most bullish estimates, a huge range.
So what do the chief economists surveyed think? Where do they fall in that range? Figure 27 shows their expectations for the next decade out to 2035.
Yes, Figure 27 shows their collective view, and it's perhaps more conservative than some of those extremely bullish external forecasts, but it still indicates a pretty significant expected impact. 46%, so nearly half, anticipate a relatively modest boost of 0 to 5 percentage points to global GDP growth cumulatively over that decade.
Okay, 0 to 5 points over 10 years.
Then a further 35% expect more substantial gains in the range of 5 to 10 percentage points cumulative boost by 2035.
So combined, that's over 80% expecting up to a 10 percentage point boost over the decade.
Exactly. And the report notes that while these estimates might be on the conservative side compared to some, even a 5 or 10 percentage point cumulative boost to global GDP over a decade is actually considered a substantial uplift, especially given the sluggish growth rates we've seen in many advanced economies in recent years. It would be a significant acceleration.
Why the variation in their estimates? Why isn't there more consensus on the size of the boost?
Well, the economists' varied estimates reflect differing views on a whole range of factors. Things like how exposed a particular country or industry is to tasks that AI can automate or augment, the pace of underlying AI innovation itself, how quickly does the tech continue to improve, the level of capital deepening required, how much investment is needed in hardware and software for AI adoption, and crucially, the capabilities of different economies and firms to actually adopt and integrate this technology effectively into their processes. All these factors contribute to the range of expectations.
Okay, that makes sense. Now, let's turn to one of the biggest and probably most widely discussed concerns when people hear about AI, especially powerful AI, its potential impact on jobs. What does the report say about the labor market outlook over the next decade, according to Figure 28? Is AI expected to be a net job creator or a net job destroyer?
Yeah, this is always the elephant in the room with AI discussions. Figure 28 presents a somewhat mixed and, for some, potentially quite concerning picture for the labor market specifically over the next decade. A significant portion, 47%, nearly half of the chief economists surveyed, expect AI to result in net job losses over that 10-year period.
Net job losses, so more jobs destroyed than created.
That's the expectation of almost half of them, yes. Only a smaller group, 19%, foresee net job gains from AI over the next decade. And the remaining 33% expect basically no significant net change, perhaps jobs destroyed, roughly balancing jobs created.
So almost half expect net losses, only about a fifth expect net gains, and a third see it as a wash. That split opinion really highlights the complexity and the deep uncertainty surrounding AI's effects on employment, doesn't it?
It absolutely does. There's no easy answer here. The report does note that some other research, maybe looking at a shorter time horizon, like the next 5 years, suggests a more positive balance between created and displaced jobs. But even so, AI is still widely seen as one of the most disruptive macro trends impacting the labor market overall.
So what's the key takeaway on jobs then?
The key takeaway highlighted in the report is that intentional effort is needed from both governments and businesses. Effort to ensure that AI leads to a win-win scenario for workers and business. A scenario where the productivity gains from AI translate into shared prosperity, higher wages, maybe better working conditions, rather than just a short-term boost for companies, followed by a longer-term contraction in overall consumer demand and living standards. If large numbers of jobs are lost without adequate new opportunities or smooth transitions for affected workers. It requires proactive management.
Right. It's not automatic that the benefits get shared widely.
Yeah.
Okay, so there are significant concerns about job displacement, but also this potential for a substantial long-term boost to GDP growth. Let's dive into the positive side for a moment. How exactly is AI expected to drive this potential growth? What are the main channels through which these chief economists believe AI will have the most significant positive impact on the economy? Figure 29 breaks this down.
Yes, Figure 29 details the top channels identified by the economists. At the very top, cited by 68% of them, is the automation of tasks.
Automation. That sounds like the job displacement part again.
It's related, yes, but the focus here is on the efficiency gain. The report explains that while previous technological revolutions primarily automated manual tasks, think robots in factories or tractors on farms, AI has the potential to automate many routine cognitive functions, tasks currently done by knowledge workers in offices.
So automating things like writing basic reports, summarizing documents, maybe coding.
Exactly. Things in knowledge-driven fields. The idea is this could free up human labor to focus on more complex, strategic, creative, or maybe ethical roles that AI can't yet do. So automation drives productivity growth.
Okay, automation's number one. What's next?
Second on the list, cited by 62%, is faster innovation. This is a really exciting potential channel. The report highlights how AI can supercharge the process of generating new ideas, discovering new materials, developing new drugs, making scientific breakthroughs much faster than humans alone could.
Can you give some examples of that?
Yes, the report gives some striking specific examples cited in the source material. It mentions Google DeepMind researchers contributing to protein science advances using AI that were so significant they actually helped earn a Nobel Prize in chemistry. It talks about OpenAI's Deep Research Initiative producing scientific papers apparently at a postdoctoral level.
Wow, AI writing scientific papers.
That's the claim. And the report even includes this rather provocative idea, mentioned in the source, that the world might be entering an era where the fundamental ideas for future economic growth are likely to be generated by machines rather than humans.
That's a mind-bending thought. Machines driving innovation.
It is. But if AI truly accelerates the pace of innovation across many fields, this could be an incredibly powerful engine for long-term economic growth and solving major problems.
Okay, so automation of tasks, faster innovation. What's the third main channel for growth?
The third top channel, cited by 49%, is worker augmentation. This is the flip side of pure automation. It's about AI tools making human workers more productive, not replacing them entirely, but assisting them, giving them enhanced capabilities, or handling the tedious parts of their job so they can focus on the higher value aspects.
So AI is a co-pilot, helping doctors diagnose, helping programmers write code faster.
Exactly that kind of thing. The report notes that automation and augmentation often go hand in hand. Automation might free workers from routine tasks, allowing them to then focus on higher value activities where they are augmented by AI tools, leading to overall productivity gains.
Are there other channels mentioned?
Yes, several other important channels are mentioned. Increased AI-related investment itself, cited by 41%. Just the spending on building and deploying AI systems boosts GDP. The creation of entirely new markets and industries built around AI, 32%. The potential for more efficient reallocation of labor across different sectors, 24%. Increased market efficiency overall, 19%, perhaps through better prediction or matching. And accelerated knowledge transfer, 5%. The report also points to significant capital deepening already occurring related to AI big investments being made. It cites large AI funding surges reported in early 2025 and mentions major government and block investment initiatives like the U.S. potentially planning a $500 billion Stargate initiative over 4 years, the EU having its $200 billion Invest AI plan, plus a large venture capital fund recently launched in China, CNY $1 trillion, about $138 billion specifically aimed at AI and other strategic technologies. So huge investment is flowing in.
Okay, so AI offers this significant potential for growth through automating knowledge work, accelerating innovation potentially with machines themselves, and augmenting human capabilities, all backed by massive investment. But as with any powerful technology, it's definitely not without significant risks. What are the key risks that AI poses to sustained global GDP growth, according to Figure 30? What are the downsides the economists are worried about?
Yes, Figure 30 details the key risks identified, and these are absolutely critical to consider alongside all the potential benefits. The top risk identified, albeit by a narrow margin, cited by 53% of the chief economists, is the misuse of AI for disinformation and societal destabilization.
Disinformation. How does that hurt economic growth?
Well, the report explains that while AI is incredibly powerful in augmenting human creativity and democratizing access to tools that create text, images, video, these same capabilities can be severely abused. They can be used to generate and spread misinformation, manipulate public opinion, sow discord, and generally disrupt the information ecosystem at scale.
Okay, I see the societal risk, but the economic link.
The report stresses a fundamental point here. Societal stability and reliable, trustworthy flows of information are actually key enablers of a vibrant market economy. When AI is used to undermine these foundations to erode trust, increase polarization, make it hard to know what's real, it can directly distort or suppress economic activity and certainly damage investor confidence. Stable societies are good for business.
That's a crucial connection. Okay, misuse for disinformation is the top risk. What's second?
The second key risk, cited by 47%, is the potential for concentration of market power. The report suggests that the inherent structure of some AI technologies, particularly things like the large foundational models being developed by just a few big companies, reinforces the winner-takes-all dynamic that we often already see in the digital economy.
Meaning a few giant AI companies could dominate everything.
That's the concern. Companies that control the foundational AI models or have access to the vast data sets needed to train them or own the key AI computing infrastructure, they could accumulate significant market power. And this could potentially stifle competition and innovation from smaller players or startups, ultimately slowing down progress or concentrating the benefits too narrowly. The report mentions the race to the AI frontier for these first-mover advantages is part of this dynamic.
Okay, market concentration. What's the third big risk to growth they identified?
A third significant risk, cited by 44%, is the potential disruption to existing business models. We talked about AI adoption, but for many existing companies, adapting to the integration of AI into their processes is actually a very complex, costly, and sometimes inefficient undertaking. They might not have the skills, the data, or the agility.
So some companies just won't be able to keep up.
That's the risk. For those unable to adapt quickly enough, this disruption could lead to declining competitiveness, potential insolvencies, and consequently higher unemployment in the short term. And if that happens across multiple sectors, it could collectively drag down overall economic growth, even as other AI-native sectors might be surging ahead. It creates winners and losers, and the transition can be painful economically.
Are there other significant risks mentioned beyond those top three?
Yes, several other important risks are highlighted. Increasing inequality is a concern for 39%, as the benefits of AI might accrue disproportionately to those who already have the skills or the capital to utilize it effectively, widening existing gaps. Increased cybersecurity risks, also cited by 39%, because AI systems often handle vast amounts of sensitive data and can themselves become targets or tools for sophisticated cyber attacks. Rising unemployment and potentially weaker aggregate demand, cited by 28%, which ties directly back into those job outlook concerns we discussed. If too many people lose jobs, who buys the stuff the AI helps produce? Regulatory uncertainty or potential government overreach is a risk for 25%, as policymakers struggle to find the right balance in governing this rapidly evolving technology. And finally, the increasingly recognized high energy intensity of AI deployment is a concern for 25%, raising worries about straining electricity grids and potentially exacerbating climate change concerns if not managed properly.
Wow, okay. So the potential for growth is clearly huge, but the risks ranging from societal instability via misinformation to market power concentration, job disruption, inequality, security, regulatory issues, and even energy use are equally significant and incredibly complex. It's a real Pandora's box, in a way.
It has that feel, yes.
Yeah.
Immense power, both for good and potentially for ill.
So, given both this immense potential and these serious downsides, what do governments and businesses need to actually do? How can we try to maximize the benefits of AI while mitigating these significant risks? Let's start with the strategies governments should be pursuing. According to Figure 31, what do the economists think governments should prioritize?
Figure 31 outlines several strategies seen as important or very important by the chief economists for countries aiming to effectively leverage AI for economic growth while also managing its societal impact. Investment is key. Nearly 9 out of 10 respondents, 89%, see increasing public and private investment in AI infrastructure. Things like massive computing power, specialized data centers, high-speed communication networks as important or very important.
Building the foundations. Makes sense.
Right. Then, fostering AI adoption across key industries, beyond just the tech sector itself, is also highly rated at 86%. The report notes that national AI strategies being developed around the world are increasingly prioritizing how to help traditional industries like manufacturing, healthcare, finance actually integrate and benefit from AI.
What about the energy issue you mentioned?
That's addressed too. Reducing the energy costs associated with AI deployment is seen as beneficial by 69% of respondents, reflecting that growing concern about AI's potentially massive energy footprint and its climate implications. Finding more efficient ways to run AI is seen as important.
Okay, so infrastructure, adoption, energy efficiency. What about governance and people?
Those are seen as absolutely crucial. 89% see developing clear, ethical, and safety standards for AI as highly important. This isn't necessarily seen as hindering innovation, but rather as enabling and safeguarding its widespread scaling by building public trust and mitigating harms.
How should they regulate it, though? It's moving so
Yeah.
fast.
The report notes a trend towards governments exploring more flexible measures in regulation, rather than trying to impose overly rigid, prescriptive rules too early on. Things like establishing innovation hubs or regulatory sandboxes where companies can test AI applications under supervision, or setting up specialized skills academies, trying to learn as they go.
And talent. AI needs skilled people.
Absolutely critical. Facilitating the movement of AI-related talent across borders is also highlighted by 80% as important, which is quite notable, actually, at a time when general global trends often lean towards less flexibility in migration policies. There's a recognition that AI talent is scarce and global.
And what about the workers who might be displaced or need new skills?
That's seen as a major government responsibility, too. Public investment in upskilling and redeployment of workers is seen as important by 75% of the chief economists. The report calls this a strong signal, underlining the widespread support for policies aimed at equipping the existing workforce to work alongside AI and unlock that augmentation potential we talked about, rather than just being replaced.
What kind of policies?
Ideas mentioned include integrating AI literacy into general education systems from an early age, supporting lifelong learning initiatives so people can adapt throughout their careers, and maybe governments co-creating specific training programs directly with industry and academia to meet emerging skill needs.
Any other government actions highlighted?
Yes, simplifying AI regulation where possible is seen as important by 80%, avoiding unnecessary red tape. Enhancing international cooperation and knowledge exchange on AI development and governance is seen as critical by 89%, recognizing this is a global challenge. And finally, investing in the public sector's own AI capabilities is seen as important by 89%, so governments can use AI effectively themselves for service delivery or policymaking.
Okay, that's a pretty comprehensive list of actions for governments. Invest in infrastructure, foster adoption, manage energy use, set standards flexibly, attract talent, reskill the workforce, simplify rules, cooperate internationally, and build public sector capacity. What about businesses? How should individual companies be adapting over the next 3 years to accelerate their own AI adoption and capture the benefits effectively? Figure 32 focuses on business strategies.
Yes, Figure 32 outlines the key strategies seen as important or very important for businesses looking to really thrive in this age of AI. The most important action, cited by a resounding 95%, is adapting business processes to integrate AI.
95%, so it's not just about buying the tech.
Exactly. It's not just about buying a new piece of software. It means fundamentally rethinking workflows, redesigning operational processes, and truly embedding AI into core activities to realize its full potential for efficiency gains, new product development, or better customer experiences. It requires organizational change.
Okay, process adaptation is number one. What's next for businesses?
Second, highlighted by 91%, is reskilling and upskilling workers to effectively work with these new AI tools. This strongly recognizes that the human workforce is absolutely crucial for successful AI adoption. Employees need new skills, technical skills, critical thinking skills, collaboration skills with AI to harness the technology effectively. It links directly to the government's role in supporting this.
And it's not just the workers, right? Managers need to understand this too.
Precisely. 83% cited the importance of training managers to develop and lead AI strategy. Middle and senior managers need to understand AI's potential, identify opportunities, drive its adoption within their teams and departments, and manage the change process. It needs leadership buy-in and understanding.
What else should businesses focus on? Measuring the impact.
Yes, developing clear metrics to assess the actual business value of AI implementations is seen as important by 74%. It's easy to get caught up in the hype, but companies need ways to track progress, demonstrate return on investment, ROI, learn what works, and refine their approaches based on data, not just enthusiasm.
And dealing with the changing rules.
Also crucial. Adapting to evolving AI regulations and the associated legal risks is seen as important by 74%. Businesses need to remain agile and stay informed as the regulatory landscape inevitably changes rapidly around things like data privacy, bias, or transparency.
Security is a big one too, you mentioned earlier.
Absolutely. Strengthening cybersecurity and data governance is highlighted by 89% at critically important. AI often involves handling larger volumes of data, potentially more sensitive data, and the AI systems themselves can be vulnerable or used in attacks. This significantly heightens cybersecurity risks, requiring more robust defenses and governance.
And finally, the data itself. AI needs good data, right?
Foundational. Improving internal data infrastructure and, crucially, data quality is seen as important by 85%. The report emphasizes that high-quality, well-managed, accessible data is the absolute foundation of effective AI models. Garbage in, garbage out still applies. So businesses need to invest in things like better data management systems, cloud infrastructure for data storage and processing, and processes for cleaning and preparing data before they can really succeed with AI.
Okay, so for businesses, adapt processes, reskill workers, train managers, measure value, follow regulations, boost cybersecurity, and get your data house in order.
Yeah,
That's also a massive transformation agenda for companies.
it really is.
So the picture emerging from this entire report, pulling it all together, is one where businesses and governments are essentially having to navigate two massive, interconnected, and potentially conflicting forces simultaneously. On one hand, you have these profound geoeconomic shifts we discussed earlier driven by volatility, uncertainty, political polarization, trade wars, fragmentation. And on the other hand, you have this incredibly rapid, potentially hugely disruptive technological transformation being driven by artificial intelligence, two giant waves hitting at the same time.
Exactly. The report's conclusion really brings these two dominant themes together, emphasizing this dual challenge. It concludes that successfully managing this period of, frankly, unprecedented disruption requires organizations, whether they're public sector governments or private sector businesses, to be incredibly agile. They need to foster a culture of continuous learning and adaptation. And crucially, they need to integrate geopolitical awareness, that understanding of the shifting world order, directly into their core strategic planning in a way they perhaps haven't had to before.
So strategy can't just be about markets and tech anymore. It has to include geopolitics.
That's the strong message. The report does offer a note of potential hope, though. It suggests that AI itself could potentially serve as a catalyst for developing new ways of growing and building resilience within this challenging environment.
How so? AI helping us cope with fragmentation.
Potentially. By helping businesses unlock new efficiencies, maybe adapt supply chains more quickly using predictive analytics, or create new forms of value in these evolving and potentially more fragmented markets. The idea is that by intentionally aligning technological innovation, particularly AI, with a clear, forward-looking understanding of the broader economic and geopolitical landscape, organizations can potentially position themselves not just for survival amidst all this uncertainty, but for actual resilience and maybe even expansion during this time of profound disruption. It's about navigating both waves intelligently.
That is an incredible amount to process, a truly detailed picture painted by these chief economists. We've heard about a global economic outlook that has significantly darkened, driven primarily by unpredictable trade policy shifts and broader geopolitical fragmentation. This has led to sky-high uncertainty, which is expected to persist and is already impacting trade, growth, and investment decisions. Businesses are scrambling to adapt by reorganizing supply chains, sometimes delaying decisions, and trying to become more agile. And overlaid on all of that is the immense yet still deeply uncertain impact of artificial intelligence. AI is seen as a powerful force with undeniable potential for long-term growth through automation, faster innovation, and worker augmentation. But it also comes with significant risks, particularly around job displacement, societal stability due to misinformation, market concentration, and inequality. And managing AI effectively requires proactive strategies from both governments and businesses, focusing heavily on infrastructure, governance, and skills development.
That summarizes the core tensions nicely.
We've seen how these geopolitical shifts are already altering trade flows, pushing up defense spending globally, and contributing to widespread debt concerns. And we've also seen AI's incredible potential to fundamentally reshape entire industries and even provocatively to have machines generate the new ideas needed for future growth.
Indeed. And the interaction between these two incredibly powerful, maybe even epoch-defining, forces this trend towards geopolitical fragmentation on one side and the accelerating AI revolution on the other is arguably the most defining economic challenge and perhaps the most compelling aspect of this entire Outlook report. How do these two megatrends collide and combine?
So building on that, here's a final provocative thought for you, our listeners, to mull over as you go about your day, based on everything we've explored from this WEF report. Considering the pressure for geoeconomic fragmentation, potentially creating a more divided, less globalized world, and considering the accelerating AI revolution, a technology often seen as inherently borderless, driven by data and talent that could flow anywhere, How might these two powerful forces interact and shape each other in the coming years?
Interesting question.
Could strategies for adopting and leading in AI become intrinsically linked to national economic security policies? Will we see countries competing not just for export markets, but for AI dominance as a strategic imperative? Could these geopolitical tensions actually accelerate AI development in some ways through competition, or conversely, could they slow it down by hindering the global flow of AI talent, crucial data, and investment, potentially fragmenting the AI landscape itself? And perhaps most importantly for you personally, how does your own industry or your specific region of the world fit into this incredibly complex, rapidly evolving, and still deeply uncertain picture shaped by both geopolitics and AI?
A lot to think about there.
Definitely. Thanks for joining us for this deep dive into the World Economic Forum's chief economist's outlook. We hope it's giving you a clearer picture of the significant forces shaping the global economy right now, and maybe some important questions to consider for yourself.